So let's begin with our big issue. More signs of weakness in the global economy.
It's concerning for the domestic Chinese economy.
China has had a relatively prolonged slowdown.
The China slowdown.
China weakness.
Domestic activity is still soft.
The trade war is simply the icing on the cake of what has been a really difficult last 6 months.
That type of data really should reinforce the need for both the President Trump and President Xi to get together and work something out.
It certainly changes potentially how aggressive the U.S. could get if they see that China's a little bit weaker kind of going into these discussions.
Joining me around the table to discuss, Michael Purves of Weeden, Thierry Wizman of Macquarie and Keith Parker of UBS. Terry, got to begin with you. Yields are getting absolutely crushed. What are you looking for today?
I don't think I'm looking for anything today, Jonathan. I think I'm looking for things over the next 6 weeks. And the main thing is going to be that G20 summit that President Xi and Trump are going to potentially meet at the end of June. And then I'm looking for that July Politburo meeting in China, because I hate to admit it, but the whole game right now is what happens in China with regard to stimulus. If this funk that we're in, or we seem to be in, all of a sudden is going to lift, and it's going to have to be on the back of some China stimulus, the kind of stimulus that we saw in Q1 coming out of China.
Michael, looking at the Treasury curve right now, 2s, 3s, 5s, 7s, those yields trading below the lower bound of the Fed funds rate. We've got a real inversion across the curve.
Right.
What is that signaling right now? What are the consequences of that?
I mean, I think it's signaling some risk aversion, but whether that's an economic signal, it's a little bit different. Obviously, a lot of ugly political noise can ultimately result in weaker economic data, right? But I think you have to distinguish what are these assets reflecting, certainly U.S. assets reflecting, a sort of a risk-off field, just the way you might see in a stronger VIX, as opposed to, the economy is going to be in a recession in 2020.
Well, the risk aversion is driving a bull steepening in the Treasury curve. This is a market increasingly that is priced for a rate cut. Do you think it delivers, the Federal Reserve, delivers a rate cut?
Yeah, I think to Michael's point, we're in that environment of uncertainty, and you can drive a truck through the bands of that downside asymmetry, and do we return to that normal growth? I think the narrative of increased tariffs, further escalation, weighing on the consumer. We saw negative retail sales. You can make an argument for a downside case, but we still see the path to a deal and growth.
Terry, it's normal to obsess over the shark closest to the boat. But the truth is, it's not all about trade, because we're positioned largely for a lot of this going into the latest ratcheting up of trade tensions. There's more than just trade going on here.
Oh, absolutely there is. For example, in Europe, I think the reason that bond yields are plummeting these lows again, bond yields in Germany are plummeting these lows again, has much more to do with what's happening in Italy this morning. The League, one of the main partners of this coalition, has increased its standing in the polls. It has become more assertive with regard to what it wants, and what it wants is a break with the EU's fiscal strictures. And I think this is one of the things that people have to watch. The other things that people have to watch, besides trade and Europe, is just what's happening in the U.S. with regard to the political outlook. There's quite a lot of uncertainty heading into the fall of next year.